Hello everybody, it's Doc here from OnTheMoneyOptions.com, and this is our weekly technical analysis. It is Monday, January 28th, and I'm seeing some things in our technical analysis this week are a little bit disturbing to me, so this would be a pretty good one to pay attention to. Technical analysis gives us the ability to see what's going on in the market without all the noise of cap-weighted indexes and things that can be used to manipulate the market. This first chart I want to start with is a daily chart of the SPY. Now the SPY is an ETF that mimics the S&P 500, and it has a little bit more information on it, particularly with volume, than you get with just the index. So we look at the SPY. The first thing I want to call your attention to is that the SPY is still running below the 200-day moving average. This is an indication of weakness. We want to see the averages stay above the 200-day moving average in a bullish move. The other thing I want to show you is in this chart, this style of charting is called Japanese candlestick. And if you look over here on the right, there's this little mark that's sitting up all by itself. Now the Japanese have a way of naming every pattern that they've ever created over the past 500 years. And this one happens to be called the abandoned baby. Now let me explain what this is. Last Friday, the market gapped up at the open, but then it traded in a very narrow range. You can see that there's just sort of a star there. It opened and closed very nearly in the same place and traded in a very tight range all day long. This morning, though, the market opened down. It actually gapped down from that Friday close. And you can see that little star shape is sort of sitting up there all by itself. And I guess that's where the name abandoned baby comes from. This is a very unusual pattern. It's also a harbinger of much more downside most of the time. So I take this very seriously and be very cautious with this market so that as we go forward. This chart's the new high-low percent. Each of the asset classes, basically, we're looking at the number of highs each day divided by the number of new lows. And if it's a positive number, the candle is black. If it's negative, it's red. So you can see that we've moved back to black candles on all four asset classes. That's the S&P, the small cap, the mid cap, and the NASDAQ. So at this point in time, we're putting in more new highs than new lows. This is the New York Stock Exchange Bullish Percent Indicator. And as you can see here, we're currently at the 41.94 level, which basically means that 42% of the stocks on the New York Stock Exchange are trading with what we call a point and figure buy signal. Now, I'd like to see this a lot higher. Also want to remind you that this still shows that we're on a point and figure sell signal, which means that there's an intermediate weakness in the market. This is the New York Stock Exchange Advanced Decline. Basically, you're totaling up the total advances in the volume in the day minus the total decline in volume, and it's a positive or negative number, and it's added cumulatively to this chart. And as you can see here, we were down a little bit, down 301 today, or down 0.6%. In this next chart, we're looking at the SPY RIS, or Relative Strength Indicator. A very interesting situation here that I've noticed is that I want to see the RIS above 50. The RIS came back up to the 50 level and then just sort of leveled off and moved to the right. This is not a good sign, in my opinion, and this warrants more caution in this market. This chart is the SPY rate of change, and as you can see here at the bottom, that the rate of change is still in negative territory. And if you look back over the years, over the past years, all the way back to 2006, 7, 8, you can see that when it's negative, the market doesn't respond well. So once again, this is something to remain cautious about. I want to see this move back above the zero line before I start thinking bull again. This chart is the relative index of the equal weight consumer staples divided by the equal weight consumer discretionary. Basically, this could be a risk measure. When consumer staples are outperforming consumer discretionary, that means the market's in a defensive mode. And that's indicated by the little red line that you see. Right now, we're still in a defensive mode. In this chart, we're looking at the VIX. The VIX right now, I was a little bit surprised that the VIX didn't move up more today than it did. I expect if there's more volatility coming in the market to see the VIX move back to the 23 to 25 level. So we want to keep an eye on this very closely. In this last chart, I like to try to introduce a new chart each week when we're doing our technical analysis. This is the chart of copper. Over a long period of time, copper has been such a good leading indicator of market activity globally that it's acquired the name Dr. Copper. And as you can see from this chart, it has peaked and has started moving back down, and it's headed very close to our long-term trend line. So this is another area that suggests that we need to be cautious in this market. So this is Doc from OnTheMoneyOptions.com saying trade carefully, trade smart, and stay hedged.